In today's video, I will talk about an alternative method of where to put your savings to allow it to grow over time. When you learn about saving money, the most common advice is to save 3 to 6 months of expenses aside. However, I think there is slightly a better approach to that advice that would enable your money to grow passively. Instead of letting the savings that just sits in a bank, you can set aside half of the savings in cash, and the other half invested into a caller option ETF that pays monthly premiums. The ETF that I'm speaking of is the Nasdaq 100 Risk Managed ETF from Global X. The ticker symbol is QRMI. This is an option caller ETF where they buy the Nasdaq index and sell at the money calls against it for monthly premiums. They will then use some of those premiums to buy 5% out of the money puts for some downside protection. These options are executed on a monthly basis. This ETF is very new. But judging by the income from its other covered call-only ETF, Qild, I anticipate QRMI to pay out around 8 to 9% annual yield. The reason I believe in allocating half of the savings into this ETF is because of the monthly premiums. That performs way better than bonds. It will also increase your savings passively over time that will beat inflation. The problem with saving cash is that it will lose purchasing value over time, so in a few years, your 6 months of expenses will need to be topped off due to inflation. So how will the savings grow over time if the ETF limits the upside growth with the covered calls? You have to look at this investment's total return with the premiums reinvested. Every month that QRMI pays out these premiums, you can buy more shares with it. Since most brokers allow for partial shares, you can buy any amount even if your premium is less than the cost per share. So basically the monthly repurchase of shares will grow your account over time, which will in turn lead to bigger passive income to buy more shares or use for expenses in the future. Since this is an investment, it still comes with risks. The risk of this ETF is somewhere between investing in high-growth index and bonds. Since QRMI buys 5% out of the money puts, you will have monthly max downside of 5%. So if the market falls under 5% every month, then your investment will fall at the same rate. But if the market crashes beyond 5% for the month, QRMI will make a profit on those puts. During the bull or sideways markets, your investment will basically stays flat or grows slowly, as you collect the monthly premiums. Keeping your 3 months set aside as cash will generally be enough to cover emergencies, so you can let the other half of the savings in this ETF to grow over time by repurchasing shares with the premiums every month. And in the worst case scenario, you can always sell portion of the investment as needed. So what do you think of this savings plan? Let me know your thoughts in the comments. In the future, I will cover more of my investment plans with other asset classes. So please smash the like button and subscribe to my channel to see more content like these. Also, if you are looking for hands-off approach to make profits from the futures market, take a look at my automated trading strategy on Collective too. You can subscribe to automated trading signals for a small monthly fee. Please check the description with the link to my strategy. Later.